David, man, I told you. I've told you and I've told you again. You can't hold your breath until rates come down. I know all the news out there, the Fed, Jerome Powell, me, realtors, loan officers all over the country. You can't do this, man. It's not safe. I'm worried about you. David, you're going to pop here. Come on, my man. Let it out. Let it out.
Rick, have they hit 3%? Tell me they're at 3%.
Why don't you start holding your breath again?
If, like me, you have been holding your breath waiting for interest rates to come down, today's show is for you. They might not, but we don't want to see you lose consciousness or lose your financial future waiting for something that is not guaranteed. In today's episode of Mortgage Monday, Christian and I get into possible scenarios, what the market could look like, what to do if you're holding onto an asset that is not performing like you thought and you're embarrassed by it. All that and more in today's episode of Mortgage Monday.
But before we get into that, David, the dream of owning a vacation home can be daunting. From finding the best guests, to the maintenance, to organizing the cleaners after every guest stay. With Vacasa, they make that dream into a reality. As a full-service vacation home management company with vacation homes in key destinations across the entire U.S., they know a thing or two about how to make owning a vacation home easy and profitable. On top of proactive property maintenance visits by professional local teams, a hospitality-driven booking platform, and around-the-clock support, Vacasa earns homeowners an average of 20% more revenue from their vacation homes. Vacasa is always thinking of ways to simplify the vacation homeowning experience by putting your home to work for you. If you're looking to make more money from your vacation home, work with reliable property managers, and finally have peace of mind, partner with Vacasa at vacasa.com/BiggerPockets. That's vacasa.com/BiggerPockets. And now, back to Mortgage Mondays.
Christian Ambassador, welcome to Mortgage Monday, the show where fun and finance met, had a baby, made this show, and then said, hey, I want to help make you money in real estate. How are you doing today?
I'm good. Does that make you fun and me finance, David?
You might be the first person ever that accused me of being the fun one, but in some way, I might have met my match, and you might be even more of a finance nerd than I am. Today, we are going to be talking about what to do if you can't refinance and or if rates stay high. For months, even years now, people keep saying when rates come back down, when rates come back down. But what if the new normal is that this is down and rates might even go up from here? What are some ways that you see this affecting the future of real estate prices, sales, transactions, cash flow, et cetera?
Really good question, David, and really one that's on the top of not only homeowners that are looking to get into the market right now, potential home buyers, but also homeowners, people who bought in the last year, the last 2 years. So many agents, even online, advisors, panels, gurus, marry the house, date the rate is a common phrase thrown out there, right? And if you go back, even into our Mortgage Monday episodes, the forecast from the Fed has changed significantly, right? Right when the new year kind of broke, we were expecting 3 to 4 rate decreases. Some publications online, I remember we're even projecting 5 or 6. Now we're down to 1 projected one. And that may not happen, right? So we're potentially going to end 2024. Now, granted, while the Fed hasn't increased the federal funds rate, we literally may not see a decrease. And we were projecting 5 to 6 when the year first turned. So really, my advice has always stayed stagnant with people. Whether you're looking to get into the market or you're analyzing your portfolio that you currently own, if a house cannot work and jeopardizes your finances, and in order to work, you need to refinance, I would never recommend making that purchase. Like I said, I know marry the house, date the rate is a super common phrase thrown around, but what so many people did is that they were so certain that rates would come down that they were accepting 8, 9, 10% rates, knowing darn well that deal only works for them at a 5% rate, and they were willing to just eat the 8% for 2 or 3 years. How I advise people is make sure the dating period works. Make sure it's not just something that you have to really struggle through to get by, but something that maybe the property can break even.
One of the issues that I'm seeing, people are emailing me, messaging, and they're saying, all right, David, I got a problem. I bought a short-term rental. The revenue's down from where I anticipated it being or where it was before. I'm now losing a little bit of money every month on this thing. I could sell it, but I would lose a lot of money. You put a lot of money into the furnishings, you put a lot of money into down payment, into the repairs on the property. So they're asking, is it better to lose a little bit at a time or to lose a whole bunch at one time? Another issue that I'm seeing pop up is someone who bought a long-term rental that needs repairs that were not anticipated when they bought. Not everybody does the BRRRR method. So some people buy a property in its current condition. They expect it to cash flow, and it will. So some of these are long-term rental investors that bought a property. The property's making a couple $100 a month, but it needs a new roof. It needs new siding. It needs a new HVAC system. It needs a new furnace. The foundation's having a problem. They have significant capital expenditures that need to go into the property, but they don't have the cash in the bank to do it. And they don't have so much equity that they can just take out a HELOC and use that to make their repairs. And if they did do that, it would no longer cash flow. So they're sort of in a position where both scenarios look bad, holding on to a short-term rental and losing money, or selling it and losing money, or holding on to a long-term rental that needs repairs that you can't afford to make. In the past, when rates were going down, the values were going up, and you could either refinance or you could sell for more than what you paid for it. So a lot of these scenarios just weren't happening. When somebody got into the position, they needed to replace a roof, they needed to replace an HVAC system. If they didn't have the money, they just sold the property. They had a 1031 exchange. They bought another one. Now we're sort of seeing that phrase, when the tide goes down, you see who's swimming naked. People that are not in a financially strong position are being exposed a little bit here, pardon the pun, when the property they have needs repairs or isn't performing well. What's your thoughts on if they should hold and wait for things to get better, or cut their losses and sell?
I think there really needs to be some self-reflection made, that especially regarding the short-term rentals, and I don't want to say the more riskier investments, but the ones where you are leaning more towards leveraging a higher cash flow in return of a higher risk. If the property's not working out and it's ruining you financially, a sale at a loss may be something to consider, right? I would get with a loan officer, right? See what a payoff would look like. Right? Is it something that can kind of right the ship and you just kind of have to accept defeat, right, on one deal because you bought anticipating rates to go down and just riding that wave forever as prices went up? I unfortunately can think of a couple of people that I know that probably going to be making that phone call to after this, right? And saying, hey, let's maybe reallocate those funds. Let's pump your reserves back up because, especially like David said, if you're going into a project where you were anticipating, maybe a cash out reimbursing your fixings that you did to the property, right? Your renovations, your, furnishings, maybe for a short-term rental, and that massive appreciation that we've seen in the last 2 years has not happened in the last 6 months. Is there enough money there for you to cash out to reimburse yourself? Or is it time to start thinking, hey, let's just make this like a true flip instead of a buy and hold? There's nothing wrong with that. It's just pivoting strategies. And it's a learning process that you can make sure that the next deal you go into, you're doing it with a little more of this in mind.
Yeah, I'm in a similar situation in some of these cases myself. You're well aware of it. There's a property manager that manages some cabins I bought in the Smoky Mountains. They're terrible. They've been fraudulent, but they're holding me to a contract and threatening a lawsuit if I try to get out of it. Now, the cabins are performing poorly and not getting enough stays because that property manager is not generating enough interest to keep them filled. I looked at selling them to get out of the agreement. The problem is if I sell the properties, I will lose, as they've probably gone down about 20 to 25% of where they were when I bought them. Now, the weird thing is I bought them at a lower price than what they appraised for. So in my mind, it feels like I'm losing money because they appraised around $650,000. They would now sell for around $550,000, but I paid about $525 for the cabin. So I'm not actually losing money, but it feels like I'm losing money. And the question becomes, just like I was mentioning earlier, does it make more sense to hold and bleed every month or to sell and take the loss all at once? It's almost like, do I want to keep losing blood every month and bleeding out, but trying to get a blood transfusion from other areas, or amputate the limb? If rates don't go down, there's not much reason to think that income properties like these cabins are going to see an increase in price, especially if the economy slowly gets worse. Travel's not going to be going up, right? So I'm sort of in that same position where if I hold it, I'm going to lose some money. If I sell it, I'm going to lose a lot of money. But am I losing money? If I sell that cabin and reinvest into a better one at the same price that performs better, did I lose money, or did I just lose money on paper and shift the debt from one asset to another one? What's your thoughts on this? Because you had mentioned if people want to accept defeat, and I'm trying to figure out, in this market we're in right now, is it defeat if you sell a house for less than what you paid for, if you reinvest that money into a new asset and you basically have the exact same amount of equity after than you did before?
Yeah, I think this is a really good question, and how I've found my way asking it to, borrowers that come to me looking for advice with the lending, but it kind of extrapolates into just kind of financial advice. Really, I ask people, would you buy the house right now at the terms you have? if you could do it again. Not at that time, because obviously everybody would have taken the interest rates from 3 years ago, knowing where we're at now. But if you had to put down the equity you have in the, right, Dave, we talk about return on equity instead of return on investment a lot, right? ROE versus ROI. But if you have, $100,000 in a rental property, would you buy it right now if you had to part with $100,000 in your bank account for the return and cash flow or potentially cash loss that you're encompassing right now? And if the answer is no, you should sell it. If the answer is yeah, I'd double down and do it again, then you're probably in a beneficial situation. And I think of all these people that have so much equity in houses, right? They have $300,000, $400,000, $500,000, $600,000 in equity when they probably only put $50,000 or $100,000 down. Would you buy that same house today if it took $500,000? Most people would probably say no. And in David, your situation where there hasn't been that surge in equity, knowing what knowing what they cash flow for, looking at Airbnb numbers in 2024 instead of 2022 and 2021, where they look better during COVID, would you buy those? And if not, is there an asset class, maybe multifamilies or commercial or something else that you would prefer to have that same equity copy and pasted into? And if the answer is yes, I need to start working on a few new pre-approvals, right?
Yeah, it's a shift in how you're thinking. The equity I have is the equity I have. That's the reality. It does not matter what I paid for it before. It's just kind of like if you're playing poker and you had a really strong hand and then the turn comes and a card comes out that makes your hand worse. It doesn't matter what you had originally. All that matters is what you have right now. But when you lose equity that you at one point had, you feel like you lost money. And if you sell that asset, it feels like you're accepting defeat. But the reality is I would be trading a cabin that's not performing well for another cabin that would ideally be performing better, and I wouldn't be in this property management headache anymore. And I'd have the exact same amount of equity after the transfer. I didn't actually lose money by selling it and buying another one. I just transferred the equity that had already been lost from one cabin to another cabin. And I'm wondering if this would help more investors to start thinking this way. If you have what we're going to call, quote unquote, a failed investment, you're unable to make it cash flow. It's making your life harder. It's making your life more financially strained instead of better. Because the goal was you were trying to gain more financial freedom and you're trying to put yourself in a stronger financial position. If you sell that asset and get some money out of the deal to put into a better one, or if you sell that asset and immediately buy a better one, did that actually mean that you lost and you were defeated? Or did you just improve the position you were in, let some other investor come in and fix the roof and fix the HVAC that does have the capital to do it, and move your money into something that doesn't need as much work, even if you lost potential equity?
I think I'd challenge that a little bit too. Necessarily chalking something up to defeat. It could be, right? It could be you just straight lost money and that's a negative return on investment, right? But it's also, the nice thing about real estate is that you still have that equity there to repivot into something new. If that property is your down payment, right? Once you sell and cash out, is a down payment on a new, really successful property, was that really a loss, or is that an ability to pivot into something else without, just kind of like you said, David, riding the wave all the way down? Then obviously I would talk about before you sell, maybe looking at new property management, maybe different insurance policy for cheaper, all these different things that you can try to fix. And if not, what can we replace it with in terms of a new asset, right? And without any more money out of your pocket, that equity in that property is probably enough to go get a different asset class, which at the end of the day would be a win that property allowed you to accomplish.
And I think that these are questions that investors need to be asking themselves right now, especially if we've been holding our breath saying rates will come down, it will get better, it will get better. It could. I hope it does. We can't make a plan based on only one potential outcome. If rates do come down, there are a myriad of options that investors have to maximize how much equity that they can gain and how much cash flow that they can gain. But if rates don't come down, we also need to have a plan in place for how you're going to mitigate losses. If a property is going to lose you $25,000 over the next year, it's better to take a loss of $10,000 now. You actually did save yourself $15,000. And if we think about, well, I can't ever sell something that would lose money, that is unacceptable, you're just guaranteeing you're going to lose more money, and you're going to have even less wiggle room and less flexibility to solve the problems of that property as your finances continue to get drained. And we're bringing this up because I get a lot of correspondence that people don't like to put out publicly on their social media saying, David, I'm in a jam. I bought this turnkey property. I paid top dollar for it. And now I've got a problem and there's not enough equity. I can't sell it without losing money. I'm in a situation where I need to dump a lot of repairs into this property. I don't have the money to do it. I don't know what to do. Or if I dumped the repair money into the property, property, I would be upside down. I would have spent more on the property than what it's actually worth. What do you do? And I just realized these don't come up very often in the last 8 to 10 years because we've had nothing but growth. All of these issues were masked by the crazy inflation and the crazy stimulus that we had. And so this was never happening. The only stories you heard about real estate were the success stories. And I think a wise investor will be humble and prudent and sit down and say, hey, it's not always going to be sunshine. Sometimes it's going to be a storm. When there's a storm, how do I batten down the hatches and how do I survive this thing? And sometimes that means eating a little bit of humble pie.
Absolutely. Yeah, I'm thinking just sharing personal stories, David. I have a property right now in Florida that I bought just before COVID, and it's a short-term rental, and it's producing well. It's a good property, but I just got noticed that it needs some repairs. It probably needs $25,000, $30,000 of work, needs some work on the roof, needs some work on the internal fixtures and stuff. Just wear and tear after a few years being an Airbnb. I could sit there and I could do repairs and keep it vacant for a month or two, right? And eat the mortgage, eat the expenses, the insurance in Florida, which is high, and pay for the expenses, or I'm considering selling it. I would probably have to credit those repairs anyways to a seller. So David, just like you said, I could chalk that up to a loss. I could chalk that up to, man, I'm gonna have to spend $30,000 whether I fix it or whether a new seller fixes it. But if I do it and list it, I also don't have to go 2, 3, 4 months here with, contractor I don't trust, with underquotes and overbids. And also while having to pay the holding cost, I can just let the new owner take that on. And even though I'm still expensing out that money in terms of a credit to the new buyer, it's less than if I would have to hold during that period, pay everything in the meantime, as well as do the renovations myself, right? So I'm currently considering this, and this isn't a property that I'm way underwater on, but still a prudent investor. Even the properties that are working for you, and I stress all you guys out there listening to this, even if you have properties that are good, that just cash flow 100, 200, 300 bucks a month, still make it an active habit, once a quarter, once every, 2 times a year, once every year even. Do a little portfolio review, see where your money is, see where your equity is, see where your cash flow is. And even those properties that are cash flowing, could that capital be better contributed somewhere else? Or could you maximize that return on equity if you did a little bit of portfolio, architecture there? David, you talk about in pillars, I know. Something to keep eye on, even when properties are working, guys. This does not just have to be a failure conversation. This could be a furthering success conversation.
There you go. So if you're going to be buying real estate now moving forward, obviously the higher rates make it a challenge to find cash flow, but they make it easier to actually get something in contract. There is less crazy competition for homes. But if you've already bought something and you're running into trouble with it, don't hide in shame. Don't bury your head in the sand. Don't feel like, oh, I'm a terrible investor and all the people on BiggerPockets made money except for me. It's not true. Tons of people are getting hurt right now. It is okay to mitigate your losses, recover some of the capital that you had, lose some of it, and then reinvest it into a better asset, because so many of these problems disappear when you look at it through a 30-year lens. There's ups, there's downs over a 30-year period of time of paying off that mortgage. You will not look back and care where your property's equity or cash flow was at any specific moment in time that you owned it. 30 years down the road, you're going to be doing great. So remind yourself of that when times get tough. Also, remember, BiggerPockets is more than just a YouTube channel and a podcast. We've got tons of resources available to you, including an agent finder, a lender finder, a property management finder, a blog, and forums where people ask tons of questions. Christian and I put meetups together. You can find out where our meetups will be if you're checking out the forums where we post them. You can also get a lot of your questions answered. So go check it out. And if you'd like to see us in person, Christian and I will both be in Cancun at the BiggerPockets conference, BPCon, where we will both be speaking. Simply go to biggerpockets.com/events and get your tickets now. If you've got a minute, check out another BiggerPockets YouTube video. And if not, we will see you next week on Mortgage Monday.